As the stock market continues to experience a bear market, it presents an opportunity for investors to create wealth. In this video, we discuss how investors can capitalize on these conditions to their advantage. By understanding the current market climate and making informed decisions based on that information, you could be well positioned to take advantage of the bear market and increase your wealth. We will provide you with actionable tips on how to identify potential opportunities and mitigate risks associated with investing in such a volatile market. One way to capitalize on the bear market is by purchasing stocks at discounted prices. When companies have experienced a downturn in profitability due to economic uncertainty, their stock prices may start to fall as investors fear for their bottom line. By buying into these stocks when they're low, it gives you an opportunity to purchase them at an advantageous price, and benefit from any future increases in value or return on investment if the company turns around its performance. Bear market is a financial term used to describe a period of falling asset prices, generally lasting for months or years. During this time, investors are often discouraged by the lack of potential returns and are usually pessimistic about the overall market outlook. In general, if an index drops 20% or more from its peak, it can be considered an official bear market. Bear markets can have a significant impact on investments and retirement plans as fewer assets are being traded and prices are lower than they were before the downturn. This means that investors may need to adjust their strategies in order to protect their portfolios from further losses. Additionally, bear markets present unique opportunities for savvy investors who understand how to take advantage of the situation in order to benefit their investments long term. The bear market is a great opportunity for investors to take advantage of their current financial situations. Investing in a bear market can be an excellent tool for those who are looking to increase their net worth. It's important to understand the risks associated with investing in volatile markets, but the potential rewards are often high enough to make it worthwhile. Investing during a bear market means taking advantage of stock prices that have dropped from their original values and can potentially offer greater returns than when stocks are rising. By diversifying your investments, you can spread out your risk and maximize your chances of success. With careful planning and research, investors can find ways to capitalize on short-term opportunities, which may be more profitable than long-term investments typically seen in other markets. Buying stocks when prices are low generally leads to higher returns over time as prices tend to rise again. Look for companies with strong fundamentals that have been affected by external factors such as economic downturns or sector-specific events that have caused their stock price to drop temporarily. By buying these stocks during the bear market, you can reach significant gains once the economy improves and the market recovers. In a bear market, investors can often feel stuck and confused about how to maximize returns. But there are still opportunities to be had, even in the midst of economic uncertainty. Here are some tips on how to make the most of your investments during a bear market. First, it's important to stay informed and pay attention to the news. Investors should keep an eye out for bargain stocks that may have been oversold but still have potential upside. Monitor any changes in key sectors or industries that might lead to a turnaround in prices. These could present great opportunities for returns on investment. Additionally, consider adding defensive stocks such as bonds or utilities into your portfolio. These types of stocks may help cushion any losses from riskier investments. Finally, when investing in stocks, it's always a good idea to diversify. The more diverse your portfolio is, the less likely you are to suffer from dramatic losses. In a bear market, investors should be mindful of the risks associated with investing as stock prices are generally decreasing. A bear market is defined as a sustained period of time when stock prices are falling, usually lasting longer than 2 months. Investors need to weigh the potential reward of taking advantage of investing opportunities in a bear market against the risks that come along with it. When considering investing in a bear market, investors should look beyond just low prices on stocks and consider other factors such as liquidity risk and volatility. Liquidity risk is the risk that an investor won't be able to sell their investments for cash easily or at all. This type of risk can become particularly dangerous during a bear market as trading activity tends to slow down. Volatility is the risk that a stock's price will fluctuate widely in short periods of time. The bear market is a difficult time for investors, with prices regularly fluctuating and the potential for losses abundant. However, while it may seem daunting, there are ways to take advantage of the bear market if you understand the key considerations to make. First and foremost, investors should pay attention to their risk tolerance when considering investments during a bear market. Risk tolerance is an individual's ability to handle large fluctuations in prices without being overly concerned about losses. When making investment decisions during a bear market, it's important to stay within one's comfort level when taking risks. It's also important to remain disciplined and have clear objectives in mind when investing during a bear market. This means having an understanding of where you want your investments to be at by certain milestones and not making emotional decisions based on short-term performance trends. The dot-com bubble of the late 1990s saw a massive rise in technology stocks, with many companies reaping huge profits. Amazon was among the frontrunners of this phenomenon, experiencing a meteoric rise in its stock performance. In 1997, when it debuted on the public market at $18 per share, it soared to an incredible high of $106.50 by December 1999, representing almost 500% growth over the course of just 2.5 years. During that time, Amazon's business model changed significantly. From initially being an online book retailer, it evolved into one of the world's leading e-commerce giants, as well as providing web services such as cloud computing and digital content streaming. Its rapid success provided investors with an opportunity to capitalize on the trend during this period, making significant returns on their investments. However, the initial excitement did not last long. In 2000 and 2001, the dot-com bubble burst and a period of stock market correction began. The Amazon stock performance has been an inspiring story since its initial public offering in 1997. In 2002, the company's share price tumbled to a low amid unprofitable quarters and investor doubts surrounding the tech giant's ability to make money. Despite these obstacles, Amazon reorganized their business model and focused on internet retailing. As a result, by 2022 Amazon had risen to become one of the most valuable companies in existence, with its market capitalization reaching nearly $1 trillion. Today, investors are looking back at Amazon's historical stock performance as an example of how to take advantage of bear markets for long-term gains. With smart investing strategies and well-informed decisions about when to buy or sell stocks, investors have the opportunity to turn daunting bear markets into profitable investments for years down the line. For those looking to gain from the current bear market, the conclusion is clear: start investing now. Despite the tumultuous climate, there are still numerous opportunities to make sound investments at a low cost. By taking advantage of this bear market, investors can secure strong returns for their portfolio in the long run. The key lies in understanding what types of investments are likely to succeed and which should be avoided altogether. For instance, some stocks may be undervalued due to negative news or other factors, but could still have significant upside potential in the future. Before making any decisions, it's important for investors to do their research. At the same time, diversifying one's portfolio is also essential when investing during a bear market, as this helps reduce risk while ensuring that any losses are minimized. Please keep in mind that I am not a financial advisor. I will only share my opinions with you, and you should always do your own research before investing. If you have found some value, please like the video and subscribe to the channel for more content in the future. Thank you.